Byju's expedition towards greener pastures is taking unexpected and chaotic turns. Its famous founder, Byju Raveendran, who is desperately looking for more funds to keep his firm afloat, was dealt another blow last week when a group of investors called for an extraordinary general meeting. This group, which includes tech investor Process and controls over 30% stake in the startup, wants Raveendran out. He is the chief executive officer of the edtech firm. Through the meeting, these investors want to resolve outstanding governance, financial mismanagement, and compliance issues. They also want the reconstitution of the board of directors of parent company Think and Learn. The current board comprises Raveendran, his wife, and co-founder of Divya Gokulnath, and his brother Byju Raveendran. Together, they hold 26% stake in the firm. On his part, Raveendran has called the move unfortunate and claimed that the group has no voting right to change chief executive. Byju's has seen a valuation cut of over 90% from 2022, when it was valued at $22 billion, to its current valuation of $1 to $3 billion. It has also seen its auditor Deloitte and board members quit, leaving only Raveendran and family at the helm. And it has just come out with delayed financial results for FY22, in which its net loss had doubled to over 8,000 crore rupees. The company owes around $1.2 billion in debt to lenders, some of whom have also filed for bankruptcy proceedings against the company.
The investor directors had resigned from the board of Byjus in July 2023. Instead, they should have actually tried to push out the founders from the management of the company, because it is the founders who have brought the company to this stage, and investor directors were doing a disservice to the company by actually going out of the board. So that's the reason I think things have come to a head. And this rights issue, I think, is a final nail in the coffin, where investors who don't subscribe to the rights issue will see their shareholding diluted substantially. So, which is obviously angers all investors, and that is not the path to take. And so that is the reason this EGM has been called for by the investor shareholders.
Interestingly, if Byju's founders are made to exit by its investors, it won't be the first such case. Investors at several other companies have done the same, albeit with each case having its own unique circumstances. In 2015, the investors of Housing.com sacked its CEO and co-founder Rahul Yadav for his behavior towards investor ecosystem and the media that they said did not conform to his role as CEO. In 2022, fintech company BharatPe had removed co-founder Ashneer Grover, accusing his family of extensively misappropriating the company's funds. Grover has denied the charges. Industry observers say that forced exits have happened in India, but this is the first time that a big company like Byju's is staring at this. So is the recent case a red flag for new startup founders?
If you look at the startup ecosystem, I think they've been able to get away with a lot which they would not were they listed entities. And for this, partly it's to do with the fact that the private equity which has supported them has given them a very, very long rope. And partly because, they feel that, look, they've created so much value and therefore they strut around. Some of them are very young, 28, 29, 30. They've not seen business cycles. They believe they're the masters of the universe. So that itself leads to some set of problems. If you're a little bit mature, you've lived through business cycles, you know that, look, there is the good which comes with the bad, and you have to be kind of prepared for both. You don't have the highs of times when are good, and just like that, you don't have lows, and you don't say it's the end of the world when the business is not doing so well. So what you need in this business is a little bit more maturity.
While India has seen just a handful of cases, West has a long history of investors showing the door to founders. Steve Jobs was ousted from Apple in the 1980s. Sam Altman was shown the door in 2023 from OpenAI. Interestingly, both returned to their original roles after some time, but in between, there were numerous founders that never returned to the business they founded. A study conducted on American startups in the late 1990s and early 2000s showed that within 3 years, 50% of founders step down from their CEO position. By the 4th year, only 40% retain their roles and less than 25% go on to lead their companies through their initial public offerings. The study found that founders also don't let go of their positions easily, as 4 out of 5 entrepreneurs are forced to step down from the CEO's post. Over the years, research and case studies on founders have alerted investors in the West to increase scrutiny over operations. So, is the Indian startup ecosystem now moving in that direction?
I mean, especially in the US, definitely there is greater scrutiny of founders by the board. The board takes, I would say, decisive action quite quickly. It happened even with OpenAI, if you saw. But obviously that got reversed. But it is, I would think it happens very swiftly in the US. In India also, I would think these things will, founders, if they have raised capital from outside shareholders, need to be aware that these things will happen.
Clearly, startups are adjusting to the new reality where capital is in short supply, and investors are more vigilant. They want to fix accountability, and founders cannot have the free run they enjoyed till a few years ago.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.